we have choices with how we influence what companies do. And so we have it as consumers, citizens, who we vote for, and as investors, where we put our money. And as Max alluded to, everybody here has superannuation, no doubt, but we don't look at it until we're usually 10 years out. So I know this because I'm a financial planner and I work for a firm called Capital Partners. I'm one of the owners there, and there's about 43 of us that do this for a living. And we invest about $1.5 billion this way and some other ways. But I'll talk to you about our view on how we invest when it comes to sustainability investing, and where that all kind of kicked off. So for a long time, and a lot of clients that I see, we have our financial goals on this side, and we're usually in a bit of a rut around there's an acceptable way to achieve these goals. We go to uni usually, or have some kind of education, get a job, work really hard, and then we invest it in the standard ways, and then we can tick off most of these on that journey. But then what we're finding is sometimes your values can be compromised on this journey, and they might be compromised at the moment, you just don't know it. For example, in superannuation or something like that. So if you've felt some tension between these two, then you're not alone. Happens quite a bit. This is 2018 survey by UBS. So 65% of people wanted a better planet, but only 39% say they have sustainable investments. So the Capital Partners journey for this started where I engaged a new client, and he has devoted his life to carbon sequestration. So he's quite big in the carbon sequestration space and all other forms of renewables. So plenty of unlisted companies out there focusing on carbon and renewables, and that was his life. But he was coming into the stage of I need to look at what are my investments doing. I need to actually get some stability. I can't run companies anymore. I need to invest. And looked at our investment offering and liked what we did, but I can't invest in this. Show me the stock list for this fund, the stock list for this fund. Can't do that, can't do that, can't do that. And it was a no-brainer for us to say, well, we need to do something because this is only the tip of the iceberg. And that was probably 2016, I think. So relatively recently. And so we worked with a fund provider to seed the first of their sustainable funds from an Australian context, which is pretty tough given we already have a small market. And then we're eliminating a lot of our market. So we couldn't do exactly what we would do is happening for international markets in the Australian context because it's quite different. And also introduced or found a way to bring together a sustainable portfolio that wasn't going to cost an arm and a leg, because up until that point, it was a bit niche and a bit arm and a leggy to get into with your money. So most people stayed in the standard approach. But that was 2018, and you go, yeah, there was a lot of noise around it, and we put together quite a big offering for it, and it's mainly the younger generation that move into this kind of investing. So I looked and go, okay, what's happened? So fast forward 3 years, that study was done in 2018, published in 2019, and then this one was done in 2021. So I don't, you pick 18, you pick 19. Fast forward 3 years. And the Russell Index did a similar survey. And now sustainable investing is not a trend. It's a market standard in such a short amount of time, because we have, so Europe, Middle East, Africa, we have 97% of asset managers have adopted it, up from 72%. So this is asset managers. Asset managers adopting it doesn't always translate to consumers adopting it. So we're an asset manager, we've adopted it, but people still need to make that decision themselves that they want to move into a sustainable investment. North America, lagging, but it's a different world. North America, if you're, let's contrast to Australia, where you've got a bit of a safety net in Australia and some great opportunities, and education and healthcare is better here. Where US, you don't have that safety net. I think it's a tougher jump for people to make, to say, well, we're going to take all these quite profitable companies away from you, and you're going to focus on just sustainable. I think there's a mindset shift that needs to happen there, but I'm not qualified to talk to that at all. I'm just making random assumptions when I see the data. But I don't think we're going to have a presentation like this in 5-6 years' time. I think it's going to be, you are investing sustainably and you're opting out if you want high carbon investments. And we're also seeing that at the moment, where voting with our finances is starting to cause havoc for listed companies. And what are they doing? They're selling their projects to private companies. So we don't really have much reach into that private world. So that's really a place where we need to collapse demand if we want to do anything. But let's start small. Let's start with the listed companies. That's all right. I can just do this. No, I can't do anything. No, I can do that. There we go. So looking at the Russell study, we can see self-serving drivers are dominating. Social good is third. And you can see why I made that comment about the US there. 31% was the North American survey result for social good. But we'll take it, right? Avoiding reputational risk, mitigate long-term investment risk, legitimate reasons. But we're not in an altruistic mode yet with this. We still need investment outcomes. And so you should, if you're going to invest your super in this kind of framework, you need to actually get a market return. And so what holds people back? They're either not aware, is the big one. They're like, oh, really, we can do that? Yeah, absolutely, I want that, when you raise it with clients. Still need a successful investment outcome. So there might be some, anything that's heavily advertised, you got to wonder, is it really that good if it needs heavy advertising? So if you're heavy advertising in a negative fashion towards other SRI funds and promoting your greenwashed fund, and I'm sure we're all familiar with the term greenwashing. You get it in finance, where it could be an Australian fund that say they eliminate tobacco and child labour and things that don't even exist in our market to begin with. That's a form of greenwashing. So there might be some help alerting people that they can still have a successful investment outcome. Not sure where to start, pretty common. Judging the tax impact of change, that's a big one for the oldies. You've invested for 20 years by now, you've got some heavy capital gains built up. You can't just sell that and move into another asset without crystallizing a lot of tax. So that's something that'd be great if the government stepped in and made it easier to move between investments and gave an exemption to capital gains tax. I think that's a huge one in the sphere I work in. So let me just talk about how capital partners look at sustainable investing, because everybody's got a different view. So this will give you one idea of what we think is important, and then you can have an idea of what to backfill with information on your own research. So to us, what we're concerned about, it's the carbon emissions on the environmental side, mostly, nuclear weapons, landmines, child labour. So, for example, Boeing is out because they manufacture cluster munitions, so they're gone. They have big military contracts. So there's some household names that are out straight away just on the social side. And governance, aligning pay with performance is Interesting. So that's environmental performance. And you might have seen what Twiggy did a few days ago, talking about aligning bonus with hitting their climate targets, their emission targets. You know, that's good governance, whether you like him or hate him. It's a good start. So this is what we're looking at when we're talking about ESG. And when we look at this, you can have an active approach. So this is a really high conviction, high impact fund. And that can be a fund that might have 20 projects that are about social good. Don't care about return, we want social good from these projects. So investing in that, it's not really investing, it's borderline philanthropy at that stage. If you get a return, fantastic. If not, at least you supported a project that did some good. Then you've got the ultra passive, where you might have a few exclusions. What we do is it's an integration approach with the fund managers we use, where you can really get a bit of both happening. So what we're looking to do, and what you should be thinking about when you're thinking about this kind of investing, is you still want, number one, you need a return. You need a return. So that disciplined approach is important. You need to find a way that you're actually going to get the market or close to the market. You don't want to, it's no good you going broke to save the environment, because you can't do much from that position. You're much better to support yourself in a meaningful fashion so that you can actually contribute, and philanthropy, that kind of thing. So that's the view we take. And then use funds that evaluate companies on sustainable metrics. So high cost funds, we're looking at people that track where directors are moving to between boards and what they've done previously, and what we think this company could do in the future. Those funds can be great, but your cost starts increasing. So you want to track metrics that are easy in terms of percentage of revenue that is attributed to something, percentage of resources in the ground, percentage of emissions that can be contributed to their business, their core business, those kind of metrics. And then underweight or overweight based on that. So let me give you an example. So the way we do it is we have an industry level, and then once we have a score for the industry level, then it's at a portfolio level, so individual companies within that. And then once you rate it using these scores, you can get an industry that will be underweighted by its very nature, and then you could have companies within that industry that are underweighted or overweighted depending on their performance. So the biggest one for us is greenhouse emissions. That's the one we target the most. And so 99% cut in potential emissions through the investments that you invest in. So relative to a standard portfolio. So this is just relative to taking an index, taking a market index, a global index, for example. So the underweighting or overweighting rather than complete exclusion. Everybody that has children or nieces and nephews know what's the easiest way to get them to do something you want. You can either take something away from them, that's a fight, or you can offer a treat. And it's usually the treat that gets you across the line much quicker. So we're not looking to completely starve everybody of capital. We want to reward those that are doing well within their negative industry, if you like. So that's why we don't exclude everybody. So what are some of those? We have, let's have a look. You know, alcohol is a tough one. There's no point excluding alcohol completely, because then Woolies are out, Coles are out. Well, Coles would have been out. Now we look at meaningful revenue for those kind of things, whereas child labour, gone. Tobacco, once again, it's something that it should be meaningful revenue. It's only the international funds that would exclude tobacco companies because we don't have any in Australia, but if somebody's on selling tobacco in Australia, it's probably a very small portion of their revenue. And then the big ones, cluster munitions, gambling, those kind of things. That's on the social side. Governance side is around voting. It's around where the votes go, because these funds have huge, these funds, you've probably seen the articles around, BlackRock runs the world, or there's trillions in these funds. So how they vote and how they hold boards accountable is very important. So the fund manager we use, majority for our sustainable investments is a fund manager called Dimensional. And they have quite an active, they have a team dedicated to what they're going to do with their voting power on the sustainable front, which is important. Now, so where does that kind of, this is a crash course in sustainable investing, where does that kind of sustainable overlay fit into the picture? Well, for the way we see it, and the way it would probably be advantageous for you to approach it, is you look at what do you need from your money. So if you're young and you have superannuation, you probably can't touch it for a long time. So an example could be you need high risk. You can afford to take a higher risk approach with your investments, given your time frame for that investment. Whereas generally you might require a lower threshold of growth assets in your superannuation if you're coming up to retirement, because you might need to start drawing down on those funds, and you don't want to be in the middle of a down market like we are now when you need the money. So that's one example of what kind of asset allocation you could need. But once you work your way through and go, okay, I need a return greater than cash. So I need some Australian equities, property, international shares on the growth side, some bonds and cash on the defensive side, and then break that out into something we can talk about later. I won't go into how we break out those to get a market return, but whatever you would do to get your market return, that's the first step, and then it's the sustainability overlay after that. And so, okay, I know I need a high growth portfolio, a balanced portfolio, a high defensive portfolio based on my lifestyle. What is available to me in the sustainable sphere for that portfolio? So bond funds, there are sustainable bond funds. Equity markets, the international shares, all the exclusions we talked about. The Australian market, a little tougher, because we can't exclude everybody that you'd want to exclude, because you're giving up diversification. So you're not going to get the market return if you exclude everyone, because you're going from a sample size of this to a sample size of that, and your risk, investment risk, jumps up exponentially as you do that. So the overweighting, underweighting becomes very important, as opposed to a very line in the sand activist approach. For something like superannuation, you might have capital that you don't need, you can afford to lose, or you can afford to have 5 years of subpar returns. You can take a more activist approach with that, and a more impact approach with that. But generally, for the funds that you're going to need at some point in the future, you need a market return. So that's why we overweight and underweight within the asset classes. All very nice. You can pursue your goals. You can have access to sustainable funds. You can have some surety that you're eliminating or reducing your carbon footprint with the money you have invested in superannuation or your own investments. But it leads to, some common questions which I might have touched on so far. Why don't we exclude everybody? Well, minerals and metals are still pretty important. We still need them. Russia's highlighted the gap. How we're responding to that, I don't know if that's right or wrong. Time will tell. But there's a gap that needs to be filled for a period of time. the energy transfer that you were talking about, Max. You know, it's going to take time and it's going to take resources. But if we focus on the overall carbon footprint, it's an easier way than just focusing on individual companies. Throw out the bad ones. And this is what I was talking about. Rewarding companies in a bad industry can help foster change. I think, well, there's obviously a cost for all these companies to move to something like triple bottom line accounting, where they start including their environmental and social aspects. But that cost, you know, will be small when you think about the lifetime of these companies and access to capital, which is so important to them. And we don't want them just to push everything into the private realm, because once it goes into the private realm, you know, we're very hamstrung on how much influence we have. It really becomes, you know, political at that stage. We need government intervention. And, you know, what are the costs? When we started looking at this, and you know, I was blown away. I was lucky enough to have dinner with this client, and one of his good friends was Tim Flannery. And I'm not to name drop, it was more that seeing those two bounce back ideas over dinner just showed how much we needed to come as a profession on the financial side of things, because the solutions they talked about and the ideas that they floated, you know, were back in 2016 were, you know, tangible. But you see the adoption of those ideas was slow then, but has really started to pick up now. And I think ESG investing has a huge part to play in that, because boards see, you know, they're looking 5, 10, 15 years down the path, and they need to make changes based on the direction of capital flows now. So where I was getting with that, was expensive, now is relatively cheap, has the same performance outcomes, sometimes better on back testing than standard investing. If you're paying a high internal cost for these investments, then you've probably got something more on the impact side than on the standard environmental sustainable side of things. So I've run through that fairly quickly, and I think I've kept it to a reasonable time. Does anybody have any questions or anything? Yes, please.